I'm Michael Fox, and this is the Prospector News Podcast. And I have joining me longtime friend and the silver guru, David Morgan. Welcome, David. Happy New Year.
Michael, thanks for having me.
I wanted to have you on early here in the new year, just because I always like to take a look at what's happened in the previous years, see what we can learn from it, and see what surprises might have occurred that we didn't see coming, and then take a look forward into the next year. So my take on the silver market last year was it was kind of like a Slinky toy. It would expand and contract, expand and contract. And at the end of it all, it was pretty much the same shape and size it was when it started. But none of this seemed to touch the silver miners themselves. Is that a good analogy for what you saw?
Yeah, I think it's pretty accurate. I like the analogy. Started off with the usual lift we get in the early part of the year, and then we got this big dip down to around 20 and the end of March, early April. And then we shot up from there from around the 20 level all the way up to 26. So that's a $6 move, and 6 on 20, whatever that is. It's a pretty healthy percentage gain. It did a high level consolidation, but it couldn't break through it, and it then consolidated. So really the whole year, as you said, ended the same way it started. Year over year, I think silver was off like less than 1% or up 1%. It was basically unchanged for the year, although the spread between bottom and top for the year was from like roughly 20 to 26 round numbers. As far as the miners were concerned, it's been really disheartening to people like me that spend a lot of time looking at the whole market. I mean, I have to look at, you know, all aspects of silver. To study a silver miner, you got to know the fundamentals of the silver market first. But the miners across the board, gold and silver, and you could actually say across the board resource sector, have just been in the doldrums for way too long. And they represent a lot of value if you know what to look for. Yet some are still overvalued, believe it or not. We took one and put it on pause or took it off the list for a while just because it's not a value investment, even though the price is low. And that's just an aspect of how I analyze markets. But the overall tone has been shifted to paper assets, the stocks and bond market for so long that the precious metals never really get a fair shake. You hardly ever hear about an analyst coming on and speaking on one of the main financial news channels. I mean, I've done it in the past when silver and gold had their 10-year bull run from 2000 to 2011. But since that time, you seldom really hear anybody talking bullishly on the metals or even in the commodity sector. So it's a market that's asleep in a way, but those quiet markets, there's an adage in the futures markets, never sell a quiet market. And I really believe that if you have your core position in the metals physically, the place to look for value and have some patience is in the miners, and really top to bottom. I mean, you can get value in the top tier, mid tier, junior producers, and speculative exploration companies. And if you weight your portfolio correctly, which is, big money, big companies, little money, little companies, or wait for a breakout, if you're more patient or technically oriented, I think the opportunity for this year, Michael, is probably better than we've had since 2016. I think that's what we're going to see this year is a 2016 type of year. We traded First Majestic. I forget the numbers. It went like from 4 to, what did it do? 4 to 18 or something. It went up like 400 or 500% for us. And silver, I recall correctly, like doubled, which proves a few things. One is that the miners will outperform the metal in a bull run. And secondly, that if you want to gain leverage without, going on margin, the best way to do it is picking the right mining.
Yeah, no, I agree. And I've been very bullish on the silver market in that I see um, it having the ability to double in price, and I'm talking about the bullion market, more readily than I think gold would double in price from its all-time highs where it's currently sitting. You know, because of that and the leverage, I still have belief, but you know, at times, and I've referred to this late in the year with other podcasts, but it seems like we're waiting for Godot, you know?
Yeah, I mean, the thing that's really a little perplexing on the silver market is institutional following. Usually, these algorithms will point out to the fund manager, money manager, family office, whoever's using the software. There's different, there's not one algorithm out there. And they'll see the opportunity to make a quick buck. Like you go back to this year, or excuse me, last year, 2023, you look at the bottom around 20, as I keep saying, went up to 26. Someone caught that bottom, but you look at the volume and it increased. Usually you can only go up or down on, buying pressure or selling pressure. Otherwise the market won't move. So you had good buying pressure, but it really was rather weak relative to later in the year. And nothing is, really write home about. And yet the market had enough buying pressure to make that $6 move. I think going back to 2016, where we had that type of a move, I was convinced, Michael, that 2016 we were back in the bull market. And so I called the top, got out of my trading positions, made really good money that hadn't been done for a while at the Morgan Report on our trades, and thought we would get a pullback, a consolidation. The market would drop in price, consolidate, and start back up. Well, I was wrong. What happened was the market dropped, consolidated, and went down. And then that's kind of where we've been here for the last few years. But this time, I do think the story is different. We're going to see a 2016. We'll probably see a pause somewhere, maybe this year, where we get a consolidation, and then we do continue up. I see no way out with what's going on in the macro picture with the Federal Reserve. And Federal Reserve really can't sell the best asset of all. And I say best asset of all in quotation marks because it's not. But the perceived best asset you can own is a U.S. Treasury, be it a T-bill, T-note, or T-bond. And yet at the long end, notes and bonds, no one's there for the auction. They're like, I don't want that stuff. I don't trust a dollar 10 years from now. I don't trust it 30 years from now. I don't trust it. And so the only thing that they don't have much trouble selling is, 3-month, 6-month, those type of things, very short duration, which is a huge signal to the market that this dollar demise is at hand. And so where do you go? Well, you listen to Jim Willie and others, and look, I mean, all I have to do is open your eyes. Well, what are the central banks doing? Are they loading up on the best asset of all, U.S. Treasuries? No, they're loading up on gold. So I think the story's there if you care to look for it. It's just people get the idea that once they get in the market, then the market's supposed to move the direction that they chose, be it long or short. And that seldom happens. And markets, basically have a mind of their own. I mean, I learned a long time ago, and one of my favorite sayings is the market knows more than all of us. It might be illogical, it might be erratic, it might be highly volatile, it might not be volatile than it should be. I mean, all those things take into account everything that's in the market. But nonetheless, the market does what it does. And for you to sit there and analyze it and go, well, this is undervalued, that's fine. But as far as this is undervalued and it's got to move a week from Tuesday, get into that kind of mindset, you're going to drive yourself crazy. You're just going to have to take, and you can do a reasonable move. In other words, you say, well, if I don't get a move within 3 months, I'm out of the trade. And I like to position trade. I like these trends that last for a long time. I just finished off a very long trend trade, and that was long platinum, short palladium. And if you look at the chart, both of them fell last year. But palladium was off something like 30%, and platinum was only off 7%. So the spread made me a ton. And I've had to trade for almost 2 years. And a spread trade costs a lot less than margin. So there's just so many good things about it. In fact, I got to digress real quick, but way back at the beginning of the market in 2000, I was in London, and I think 21 or 22, 2001 or 2002, met a fund manager in London, talked to him, talked about a spread on copper gold, and he made so much money. He wanted to pay me. Well, I don't even know if I was consulting in those days, but he bought my mastermind membership, which is my most expensive one. Kind of like, give me a spiff or whatever you might call it. I don't know if I should say that publicly or not, but it was very nice of him. I certainly didn't ask him. But anyway,
Well, it's
coming
good to
back
be
to your question,
appreciated,
I
though,
think,
isn't it, David?
I'm sorry, go ahead.
I said it's good to be appreciated, though, right?
Absolutely. No, he saw the opportunity, he wouldn't have seen it on his own. I gave it to him and showed him why. He followed it up with his own due diligence. He took action. He made a lot of money and he thanked me for it. I mean, there's nothing wrong with any of that. But yeah, it is nice to be appreciated. I bet it is.
Yeah. Now, I again, I look at where the gold market is, and then I look towards the end of the year. There was some surges of silver where silver moved at a more rapid pace to gold, and it started to bring the gold silver ratio, down a little bit. And for a couple of trading weeks, it was actually down below 80, which was, to me, was a bullish sign. And then silver fell off and gold surged again. Is there a decoupling between the gold and the silver markets that occurred last year, or is that just a coincidence?
Yeah, that's a tough one and an excellent question. In fact, I wrote about it, I think last month. And I picked it up from Jim Dines, to be totally honest. I mean, there's digressing slightly just to make the fundamental case. The Dow Jones needs to be supported by their transportation. So the industrials need to be supported by their transportation and utilities. In other words, it has to be confirmation. And Jim Dines picked up that same idea with the metals, that like silver had to confirm gold to move or vice versa. And I look at that and it's an arbitrary art form. I mean, there's no, it's got to be exactly this number. I used to use 70. And so when the gold silver ratio got to 70 or below, silver was confirming gold's move or vice versa. And, as you said, we've been in the 80s for most of the year. So I'm not saying gold is, not in the right place. Obviously, the market knows more than anyone, as I just said. The point being is, I am concerned that silver really hasn't confirmed the move yet, especially with, the amount of industrial usage that continues to climb. And again, the perplexing thing is, why aren't any institutions involved in the silver market anymore? And if you go back to 2020, which is all that long ago, and you go to what's now known as the WEF, World Economic Forum, but in those days, everybody referred to it by the city it was in, Davos, Switzerland. A gentleman that was the chief investment officer for Guggenheim was interviewed by Bloomberg's finance guys, and he was asked, what's your go-to investment for 2020? And he said, my go-to investment for 2020 is silver. And the guy almost fell off his chair. So no one uses the word silver ever, especially at that level. And the guy came back and said, silver, well, why not gold? And Scott Meaner, the chief investment officer for Guggenheim, said, because gold is within very close distance of its all-time high, but silver is off 60%, and it represents a far better value. Well, if you look back at that year, it did pretty well. And so I don't know. You don't need a lot of big money moving into the silver market to move it. I mean, Hunt's proved that. Scott, I think, took a big position that year. The institutional investors were at 320 million ounces through the ETFs in 2020. And now we can't get to 100. So there's something going on here, in my opinion, conspiracy or not, coincidence or not, that the participation level is almost all retail and industrial. The real opportunity, as Scott pointed out in 2020, exists. And yet you don't see anyone coming in to take advantage of that spread. I mean, you could do a spread trade like I just outlined. I mean, that would probably be a pretty safe spread, would be to go long silver and short gold. Even though gold's probably going higher this year, it won't go as high as rapidly as silver will. So I'm not suggesting anyone do that. I'm not giving financial advice, but having a very good trading background and having done it for so many years, it's something to contemplate. I would be concerned. I am concerned, but I'd be very concerned if we saw gold take off to a new high in, let's say, US dollar terms, let's say 2160, stay there, break out to like 2200 and silver still be in the low 20s. That would really concern me. In other words, if the gold silver spread got bigger, like 85, 90, that type of thing. I don't think that will happen. I mean, it could happen on a day or two, but then silver would start to shoot up and catch up with gold. Um, and the other thing is the spread between the Asian market and the US market. I mean, there's still an arbitrage opportunity, but in the physical market, it's hard to get it, even though there might be $100 differential. It can only really be done effectively using synthetics, which means using the paper markets to take the metal out of London, you know, market, ship it, get it handled and all that. By the time you do all that, is it $100 an ounce? Probably not, but it's cumbersome. It takes time. It's very inefficient, and the inefficiencies cost. And so that spread comes down from 100 to 80 to 70 to 40 to $22. Is it worth it? Because in the interim, there's a move in the market. So anyway, so people see those spreads and go, oh my goodness, well, the only people that really get to take advantage of those are spread traders that see the differential and can be in both markets at the same time, which is usually your more sophisticated institutional types. So maybe they're just too carried away doing those type of trades, Michael, and not even seeing the overall fundamentals. They don't really ever pay attention to fundamentals. Everything that they do is pretty much on a technical basis, but yet the fundamentals are key and will continue to be so. And because the fundamentals for silver are so strong on a industrial basis, and of course the monetary crisis. I mean, anyone outside of North America that doesn't look at it as just an industrial commodity, and many of us don't, but a lot do. Anyone that's in a Romance language knows that silver means money. Anyone in Asia knows that this caricature for silver is the caricature is a bank with silver bars in it. That's a bank in Chinese Mandarin. So I'm still, I'm overly optimistic. No. Am I concerned that the ratio is so high? Yes. Is the ratio going to change? Yes. Is it going to change in favor of silver? I'm 95% convinced that it will.
Yeah. Now, as we look back through 2023, and yeah, it was a flat year as we discussed, but was there anything in particular that, stood out and surprised you going, wow, I didn't actually see that coming, apart from war in the Middle East?
I'd say, yeah. I mean, I'm trying to be gut honest as always, but I think it was when we got into the 26 level and still the volumes were pretty good. We had a high level consolidation. And I felt that we would break higher, and we didn't. And that kind of surprised me because the market's tighter than the price would indicate. But again, unless you get that big buyer, which usually comes again through the institutional side, there's not enough oomph in the retail market, really. And most of your, industrial users either have it warehoused already or buy it on a just-in-time inventory basis. And so that buying pressure just is not there all at once. And so I think that was something I was wrong about or kind of concerned me. I'm still concerned about it. I mean, it's like, well, where are these people? Have they been told, don't you dare buy any ETFs? We need that, to fund the physical side. I mean, they've been draining out, not, adding to supply. And so, well, why is that? And the answer is, I don't know, but it looks a bit suspicious to me.
Yeah. If I were to talk about my biggest surprise, it had no real effect on the silver market, but it was I guess a demographic surprise as I guess, or a psychographic maybe surprise that I got. I was at the Silver Symposium that was held in Las Vegas in October last year. And the big surprise to me was the number of crypto kids, for lack of better term for them, cryptocurrency and Bitcoin investors that were at the Silver Symposium that were taking up the notion that, and I'm going to be facetious and use their term, that there may actually be value in the boomer rocks again. And up until that point, I always treated the Bitcoin crowd and the precious metals crowd as like the cattle and the sheep crowd of the old West, that those two just weren't ever going to get along with each other. And that's not what I saw on the floor of the Silver Symposium. And it was a small sample, but I'm wondering if you think that that might be an area to look for that there might be, that's where the new investors are going to come from, is from the crypto people. One of the feedbacks that I was getting was they can make huge profits in the cryptocurrencies, but because of the huge swings, they would protect those profits using gold and silver.
Well
Your
said. And
thoughts?
yes, yeah, absolutely agree. I attribute Rob Goodman, the one that founded the Silver Symposium, for putting the two together. And there are some that are one or the other, but there are many that are both. And the reason you outlined is exactly right. You can make some obscene profits in the crypto world, but you also could see some extreme volatility. And if you can take partial profits and pump it into something that's stable on a long-term basis as precious metals, you've served yourself and your family well. I mean, really, if you look at a long-term perspective, there's only three things that are legacy investments: something you give to your children's children's children and know that it's going to protect their wealth or enhance it. And that's real estate, gold, or fine art. And so if you're in that modality and you understand how money works in the long term, you're actually foolish if you made some huge gains in the crypto world and not put some of it into the precious metals. And I think that crowd pretty much understood that. Maybe not from that perspective, but they intuitively understood that, precious metals on the longer term are not a thing to run from. They're a thing to covet at the right amount. I mean, most people that get upset with an investment class is because they haven't diversified and they've overextended in that one particular class. I mean, if you're all in on Bitcoin, you're a Bitcoin maximalist and the market's moving in direction, you can't get enough of yourself. But once the market turns or goes against you, either early on or later, and all of a sudden you've got some losses or missed a huge profit you could have, might have, should have taken, you can beat yourself up. But if you're balanced in your portfolio, and something's going up while something else is going down, you certainly have a better psychological advantage. Nothing wrong with taking a huge position in one asset class if you are oriented to be able to handle it. But most people say that they can, and then when it actually takes place, they discover that they cannot. And that's one of the things I've faced over the years, Michael, is the amount of people that hear the fraud. I mean, they listen to me or somebody like me and someone in our genre, and it's like fiat's, funny money and putting it out of thin air, and they give it to their buddies first, and they get to take advantage of all the rest of us. And getting something for nothing doesn't work, except the whole system is built on getting something for nothing. I'm out of here. Put my money. I'm going to put myself in my old gold standard. Well, in theory, that sounds good, and in the long term theory, it's probably a sound something to do. But from a practical perspective, you don't want to do that because you need to live in the field world until it fails. And because of that, you need to diversify. So there is a right amount for everybody. In some places or cases, half your money in the metals might be the right amount. For some, everything. That's very rare. For others, 10% is probably enough. And you can be in your Tesla, you can be in your cryptos, you can be in your real estate, you can be in these other things, and then have more of a balanced life. I mean, nature preaches balance. So if you don't have a balanced diet or a balanced exercise program, if you're extreme in anything, there's usually a price to pay. So your portfolio should really be balanced as well.
Yeah, no, that's true. Balance is probably the most important word in the English language, and a lot of us have a hard time struggling to find that balance. Let's pull out the crystal ball, David. 2024. You've kind of touched upon it in part of our look back, but what do you see for the silver market going forward into 2024? And are there any other surprises? And if there are, where do you see they might materialize?
Yeah, I wrote the January issue, and I don't even remember Exactly. I know I said I saw a high for gold around 2,500. And then I wrote after that, I think that I'd saw at least a 70-to-1 ratio. So that put silver over 30, 32, 3. And I think that's what I'm looking for. The the problem and the opportunity in silver is that technically once you get above 32, 33, it doesn't have any upside resistance. So there's not a lot of people holding at 35 or $40 silver that are willing to sell it back into the market. So once it goes to 35, 36, 37 and beyond, everyone that owns it's going to hold on to it. Oh, there'll be some profit taking, but very little. And so when you got everyone holding and a little bit of more buying, that's buying pressure, which means the price goes higher. I don't know if you've watched the movie that was about GameStop. I think it was called Dumb Money. I just watched it a weekend ago, and it showed how the retail investors really took it to these hedge funds. And really all they did was they held their position. They call it diamond hands. And so if everyone's holding, it doesn't add to any buying pressure. It's just that any additional buying pressure, even if it's a small amount, adds to it because no one else is selling. And so you had all these shorts that had borrowed the stock at a much lower price and had to, buy out their position to uncover and get out of their loss. It was quite fascinating, but it's, just basic market dynamics. But I would say fascinated by, but it's eludes me sometimes that people don't really know how markets work. And that, that movie points it out very, very well that even the little guy, if he's willing to, hold on. And that's really the silver market. Most people that buy it hold it. The problem with silver for the retail investors often, as I just said a moment ago, they overextend. And now they've got these 2 bags of silver, and that's the only liquid assets they have. And they get a car repair, and they got to take, some of that silver out of the bag down to the coin dealer and turn it into fiat to make an auto repair. And not a corny analogy. I mean, there's somebody probably doing it as we speak right now. So it's very liquid, but it's something that some people have to dip into from time to time. Well, you don't see that very often with the gold investor. There's really a bit of a difference. Most precious metals investors are precious metals investors, but there is the class of people that are silver only. And those people usually are on a thinner margin, let's say, don't have as much wherewithal to meet, unexpected changes in their financial lives.
Yeah, no, and the other danger with those types of investors too is that they'll ride the silver all the way up, and then they'll ride it all the way back down again too. So that's the other side of that particular coin, is that they don't get out of the market when they probably should get out of the market to preserve their wealth.
Yeah. And I have very little guilt on that because I've called every top so far, and hopefully I'll get the next one. But even though I am anti-fiat, and I am, if that's the only opportunity to take a profit, you should take it. I mean, you can take it and pay off bills. You can buy a business. You can buy stock. You can buy real estate. You can buy a car. You can do whatever you want. You can keep it in fiat, but at least take a partial profit, if not a full profit. And I called the top in 2011. I'm glad I did, but really I was wrong in a way because I thought the consolidation would take a couple of years at the most. I mean, 3 at the outside. I never dreamed we'd be looking, basically at a 10-year, you know, change in the market. I mean, gold, I have not have the chart in front of me, but maybe I can get it up here real quick. But yes, this scale is pretty bad. So we peaked in September 2011, and then we went from we're at roughly 2,000 all the way down to like 1,000. So we got cut by 50%, and that was in 2015. So that was 4 years in, and then we didn't get back to 2,000 until August of 2020. So 9 years to make a round trip. That's a long time to hold on.
Yeah, it is. And the market would have shaken a lot of people out during that time. It's
Yeah.
it's kind of hard to hold on to your beliefs when they're not being actuated a lot of times. So um I was privy to an interesting podcast about a week ago, and I'm going to throw this past you to get your opinion on it. And it was about the silver miners and the cost of production for silver. And the one thing that struck me is I thought the particular commentator had the average OPEX rather low, because I think it's actually higher than what he had. But what he was basically saying that if we could get the silver price to get up to $30 an ounce, you would start to see silver miners with about a 30% return on their OPEX, because he had, by his math, he said the OPEX was around $21 an ounce. And so there would be $9 worth of profits, and that would go a long ways to helping the silver miners start to gain a lot of credibility moving forward and start to put a bid under. And he went even further, and then this is where I'm going to ask the question, that the gold miners, because most gold mining companies have a lot of silver in their portfolio as well, even though that they're gold specific, but they're not getting a whole lot of credit for their silver at these prices. Are we wrong to be looking at the gold market? Maybe is it the silver market that's going to put a bid underneath these miners rather than the gold market? And that's the question I had for you, David.
Okay.
I know there's a lot to unpack there.
Yeah. Well, let's go from the top. So the top six silver miners as of the middle of last year, um, the top six going from top to bottom as far as cost, all in sustaining cost plus taxes due, was 26 an ounce, 24, 23, 23, 22, and 21. So to get to, any margin is acceptable, but there was a paper done. I have it on for the members only, called Archie's Rule. I got it from Dr. Peter McGaw, who might be one of the best. And Archie's Rule basically said that you had to have all in sustaining costs at 50% of the market price to have a viable, long-term, sustainable, profitable company. So if you had $20 silver, excuse me, if you had $40 silver, that would mean your all in sustaining cost should be 20. So if you had $30 silver, then you should have 15. Now that's a rule of thumb. It's called Archie's Rule. Again, I wrote about it. It's an asymptotic curve. If you know what that means, you can look it up. If you don't, as price varies on the longer end of the curve, it doesn't matter as much. But I would say, we need a good margin. I mean, a $10 margin in silver price. So going to the top one of 26, add 10, go to 36. It would certainly help them out. The problem is that all mines end in failure. So if you're a big miner like Hecla, what do? Well, you've got to find another project out there, which means you usually have to pay a premium in a hot market. And usually that's when they're running out, because you're mining the heck out of, getting all the profit you can. I would say, should we be looking at silver or gold, the latter part of the question? I would say further out, yes. Right now, no. I know that's kind of avoiding the question somewhat. But as we move through this new monetary system, however that unravels, and I've certainly spoken about it in the past, we may get to a position where gold really doesn't matter as much in the monetary system. Now, hopefully, we do see the precious metals tied to the new system. And I know many of us say absolutely it will. And there's some of us, such as me, that are undecided. I'd like to see it, but whether it'll occur or not, I don't know. If that were to be the case, you might see silver actually have a more determinant because it's more valuable. Let's just do a real quick thought experiment. It might answer the question better. Let's say that we go in a deep, dark depression and we're only spending money where it's absolutely needed. So that means to grow food, to get water, and to produce minerals that are absolutely essential. Gold isn't much essential for anything, but silver is required for everything. So you'd want to, you'd want to drill for oil or extract oil or energy, grow food, and get silver. So if that were the case, silver would become far more important. And it is in that sense. But as far as monetarily, it's not, because the banks chose a long time ago that the only monetary asset in the precious metals was gold. They left silver out in 1873, and I'd say deliberately. But that goes back to, me being a kook and all the rest of the criticisms I've received over the years, which is fine. But remember, the word for silver and the word for money is synonymous in all the Romance languages. It's not gold.
No, no, it's not. Okay, so essentially, this guy had a valid premise, but his math failed. In that
Well, for
he
me, it
said his
did. I mean,
OpEx, he
yeah,
said
yeah,
his all-in and sustaining costs far too low, but the same math still applies. So, in order to get to what he was, you know, you know, well, I'm looking for the right word, but outlook, we need about a $36 silver price, not a $30 price. So we've got a long ways to go before we get to that question as to whether the silver's become more important than the gold.
I would say so. Yeah.
Okay. So last question as we look forward to 2024, if you were going to project where the gold and the silver price is going to end up at the end of the year, what would your projections say and why?
Yeah, so I said I looked at gold doing about as good as it did this year, which was a 13% gain. So that put it, I forget, at 2350 or something. I said I expect it to get to 25, best case, unless there's a one-off. If there is a black swan, Strait of Hormuz blows up, another war breaks out, there's, an A bomb's dropped. I mean, any of those things could, shoot up the market up limit for, 3, 4, 5 days in a row. But barring that, yeah, $2,500 gold. Silver, again, I just used the 70-to-1 ratio as kind of a basis, and that puts silver somewhere in the 32, 33 range. That's what I think. I'm being somewhat conservative, but unfortunately, these metals really, they're constants. I mean, there's a book written called The Golden Constant by Professor Jastrom that proves that gold over a long term basically doesn't change in value. It maintains its value, which all fiat currencies don't do, which is why you own gold. But it's, well, geez, I could buy the same amount of oil 100 years from now than I bought 100 years ago with gold. Yeah, that's the whole idea. So a lot of people have the wrong idea about gold, gold and silver, is that it's supposed to make them money. Well, they might make them a larger amount of fiat, but what's the value of that fiat do? So if you price it in terms of gold, you realize that that house from 1970 costs the same in terms of gold as it always did, or maybe it's a little less. But people aren't taught to think that way. All they're taught to do is chase a number. And I bought my gold at 1800, now it's at 2024 and I'm up $200. Okay, fine. That's all true, but that's not the purpose. People actually, it's better, I think, to educate. And I've done my best, as you know, Michael, to try to get the basic concepts across to the public so they understand the why behind that investment. Because really, and I hate to use the word insurance because I don't think gold is necessarily insurance, but many people do. And you can make the argument, it's a strong argument that, gold insures the rest of your portfolio, that no matter what happens in the currency markets, the stock market, the bond market, all the financial markets, even in the real estate market, you're going to have that balance that you need, that if everything else goes down the big creek, you're left standing, and probably standing whole, because you do have a gold position.
Yeah, well, that alludes to advice I got when I was a lot younger, and it was gold was insurance, silver was money, and you never sell real estate unless you have to.
I like that. That's really good.
That came from a very wealthy family in Vancouver that shared that, and it's always something that kind of stuck with me, and I kind of look at things and, that was 20 years ago. I heard that and it still seems to ring true today. So, back to my, my younger years, it was a good idea if it survived a hangover, and that one would have survived many a hangover. So that's the way I look at it. David, it's been a pleasure having you on. I look forward to seeing you in the near future, and we'll have you back on as the year progresses and we start to see movement in the silver markets.
Well, thank you, Mike. I appreciate it. Enjoyed the time together.
Thank you. The Prospector News podcast is for educational purposes only. The opinions expressed are those of the participants and are not to be taken as investment advice. Listeners need to do their own due diligence and seek advice of a licensed investment advisor.